having that disciplined plan that you stick to when times are difficult. Times are difficult right now, and this is where the most people are deviating from their plan. If you can stay disciplined during times like this, the odds of success skyrocket.
Hello and welcome to the REIT Report. I'm your host, Sarah Borgson-Keto. April is Financial Literacy Month, and joining me to focus on some of the issues and challenges for anyone trying to either begin or continue investing in today's volatile markets are Dave Giulieri and Michael Svec, Senior Portfolio Management Directors and Certified Financial Planners with the Chesapeake Capitol Group at Morgan Stanley. Dave and Michael, welcome to the podcast.
Thanks for having me. Yeah.
So I think an important question to start with is, if you're just starting your personal investment journey, what are some key questions to ask a potential financial advisor?
I would say, one, experience of the financial advisor. How long have they been doing it? I would ask about their process. What is their process? With us, it's a kind of a 3-step process. I won't get too deep into it, but they ask questions first. Ask what you're trying to accomplish, put a plan in place in the second step, and then regular reviews. So find out about their process, make sure you're comfortable with that. Obviously, the compensation, how are they compensated? Most people today are compensated on a kind of a fee basis or an annual basis. We're compensated the same way, but you could have a financial advisor who's compensated per trade or anything like that. That there'd be a conflict of interest for that. So I'd ask about the fees, how they're compensated, and then make sure who you're going to work with. Sometimes you may talk with one financial advisor and he may turn you over to a different member of the team. You may or may not like that, may not be a good thing. So those are kind of questions I would start with.
The only thing I would add, Sarah, is fit, meaning a lot of potential investors are not necessarily good fits with their advisors. And it doesn't mean that either is a negative. It's just like any relationship. As far as what's their typical clientele like? Do they look, feel like me financially? What age group? What amount of assets? What are the biggest problems, issues, challenges? Is it debt to equity, or is it somebody who's older and has estate problems and so forth? So all the things Michael said, plus just make sure you're a right fit with that advisor or advisory team.
Great. And how do you approach the need to have funds available for key financial milestones like buying a home or paying for college, with ensuring that you're also looking to save for retirement?
So if you're just starting out, the best news and the worst news is retirement's a long way away. The reason why it's the worst news is because things that are a long way away tend to get procrastinated and they tend to get forgotten. The reason why it's a good news is because it takes relatively small investments when it's a long way away to accumulate to something more meaningful. So if you can communicate, get the message that start retirement as early as possible, it will make it a much less stressful and much more rewarding experience. The problem is to get 20 and 30-year-olds to think about when they're 60 and 70, it's a challenge, right? They're trying to make those more, what you were talking about, those educational expenses. And education is one of the things that we think is one of the bigger challenges because it costs so much. And more relevant these days is student debt. And so you've got to clear the student debt or at least minimize it because it is in the calculus, it's in the formula for buying a house and qualifying for a mortgage. So just imagine you're just coming out of college, you're entering the workforce, you get tens, if not hundreds of thousands of dollars of student debt repayments. You're trying to get to the 20% mark, which I'll touch on in 1 second. And you also know that the earlier you start for retirement saving, the better off you are. And you still want to live a life. It's a lot of demands. So I would personally recommend that you compartmentalize student debt, if anything, with repayment, accelerated repayment with the highest interest rate being targeted first, and then start a separate fund. Mike likes to call it pay yourself or build it yourself, really targeting 20%. If a house is $500,000, you want to accumulate a fund of $100,000 or 20% of that purchase price. And the reason why you do 20% is that qualifies you for the best terms, the lowest interest rates and so forth with mortgage companies. Typically a lot to balance. And that's why having a plan is the most important part. Mike, you have anything to add?
Yeah, I would just say just prioritizing is You got to prioritize. And with you just look at retirement and education, with retirement, the buckets of money are going to be your 401k, your IRAs. You would have money going in there. And then just with education, you're going to use what's called 529 plans, which are tax deferred. So you can put money in there. If you put it if you're in that state, you may get a little bit of a tax write-off from your state. It's not much, but it's something. And then that money goes tax-free, as does the retirement funds. And then when you take it out for college, it's tax-free as well. So there has to be a little bit of just prioritizing a little bit. But those are two ways. You mentioned retirement and education. Those are two specific ways you can attack them, if you will.
Excellent. And what advice do you have for anyone who's already on the investment path with a 401k or other investment vehicle who's tempted to look at their latest account statement right now?
Don't look. That's the best advice. In the long run, markets go higher. We could show you data piece after data piece. In the short run, they correct all the time. The normal market correction is anywhere from 10 to 14%. And we certainly hit that this year a little bit. We're in that range right now. But you just realize that happens every year. And people's goals are generally long term. If you need cash right now, you should have something on the side for cash in case you need it for living or lifestyle stuff. But as far as corrections are perfectly normal, and you don't want to make any rash decision or an emotional decision to sell anything right now. So focus on the long term. They happen every year. They're hard to go through, but certainly don't sell or do anything emotional when the markets are down like this.
Quick add is I would actually spin it to this as a positive. And I know when you look at your statement and you've lost money from one period to the next, that's typically not viewed as a positive. But if you're continually adding and you're not within 6 or 12 months of retirement, I would actually really encourage the thinking to be you're buying low. You're getting a discount here. And this is why so many 401k balances, retirement plan balances can grow to be significant. When I say significant, I'm talking about hundreds of thousands, if not millions of dollars. Is because they're done regularly and they're actually done through difficult periods like this where you're actually buying low. So for younger retirement plan investors, this is absolutely an opportunity. And when Mike says don't look, he's actually really saying don't pay attention. Don't get dragged down by the negative news. This is something that will pass. And actually, when it does pass, you'll be better off because you'll have a higher balance and you will invest it at a lower level.
Great. So that leads into my next question. It does sound like it could potentially be a good time to either begin investing in the markets or put additional funds in if that's feasible.
Couldn't agree more. This is what we're actually having our most productive conversations with our clients with today is where are you on the time frame? Where are you on if you can put money away and again, like Mike says, don't look or don't get emotionally invested in seeing something down over the next few months. This is how wealth is built and accumulated, is investing during times of stress. And it, Sarah, reminds me of the old Warren Buffett quote that is on a lot of financial advisors' walls and bulletin boards. It's when everyone is fearful, he likes to become greedy. And when everybody's greedy, he becomes fearful. So basically doing exactly the opposite, the emotion of what the headlines and what your statement is telling you.
Yeah, nothing more to add. 100% when the markets are down, it's a great time to invest. It creates an opportunity.
So can you describe what a balanced investment portfolio might look like and how REITs could fit into that?
Mike, you want to take this one?
Yeah, sure. Like a balanced portfolio. When you say balanced, you're talking about stocks and bonds. Stocks, for those of you who don't know, are riskier assets. Bonds are less risky. Cash is the least riskiest asset class. So you would have some in both stocks and bonds. Balanced portfolios are considered approximately 60% stocks, 40% bonds. You can argue 10% either way, but they have to put their balance between those two. And you want to have large companies in there. You want to have your technology companies in there. You want to have your consumer staple companies in there. You want to have some international companies in there. You want to have large companies, small companies. You want to have different types of bonds. You want to make sure you're diversified. Then what you do is you overweight kind of areas you might like, or what your financial advisor likes, you overweight. But you want to make sure you're well diversified. Don't put all your eggs in one basket. For example, we could think Morgan Stanley is the greatest company in the world. We work here. Let's put all the money in there. That would be foolish to do. Then when you add REITs into the equation, they're a great diversifier as well. So anywhere from 5 to 15%, you can argue to have in there. A good hedge against inflation and a good diversifier in general versus other stocks. So that's how we would do it.
Only thing I'll add is when you're going to hear the word in the financial community a great deal called diversification. And it's a little bit more than just don't put all your eggs in one basket. And the theory is you want to have highly productive investment vehicles in your portfolio that don't all move in the same direction at the same time. So, for example, a time like now, where the market's down or 10 or 15%, the stock market, it's good to have investments that are moving in the different direction because that lowers the overall volatility or the risk of a portfolio. And so when we say balanced, when we say diversified, basically what we're saying is build in strong investments that don't all move in the same direction at the same time. Technically, that term is called low correlation. So right now, we're really looking for investments that don't move with the stock market or ideally move in the opposite direction. So actually these investments where you're making money in this time. And typical investments like Mike touched on are bonds. Another name for bonds is fixed income. So it just locks you into a higher yield than you would otherwise get at the bank. And real estate, also a hard asset that typically doesn't suffer or is subject to the same high volatility day to day that the stock market is. And so if you can put these pieces together, you're really starting to build a solid portfolio.
Great. And what are some good resources for early stage investors? And do you have suggestions on how more experienced investors can ensure that they're staying well educated and calm in today's volatile environment?
That's a double-edged sword. It really is. Because while the internet is a great resource, it's also one that, can bombard you with news. And as we know, at least the news companies know, that the most viewed, clicked, eyeballed news is not the one that helps you stay calm. There's not very many websites or investment tools out there that are very popular that say, stay calm, make wise investment decisions and calm investment decisions during times of turmoil. For whatever reason, the human brain is not attracted to those. And so therefore, the news is incented to get people to check back every day, every second, every moment. And therefore, that news is highly volatile, which is counterproductive to building and maintaining long-term growth. So while news and so forth, I wouldn't avoid it, but I wouldn't let it really impact my investment decisions. So I know this is old school, and that's why I hesitate, but books that have been written decades ago are still are tried and true, like we were talking about before. Stay disciplined, build a solid portfolio, a well-diversified, low-correlated portfolio, add when times are difficult. All these books that were decades old that are not feeding into the moment are huge resources and really help focus even the young, the middle-aged, and the older investor.
Yeah, I would just add talking to your financial advisor. That's probably your best resource if you have one. And like Dave said, you want to, books are great. You just want the resources to be reputable. And you're on the internet, not everything is.
Right. And we've covered lots of ground, but anything else that you'd like to share during Financial Literacy Month?
I would just say have a plan, stick to it, do your best to keep the emotion out of it. And it's times like this when emotion creeps in and you see the market going down and you want to sell. And then when the market's up for a straight year and it's going up, making new highs, all you want to do is buy, and you just want to take that emotion out of it. So you have a plan, stick with it, realize there's going to be hiccups along the way. It doesn't go straight up. It corrects every year. The norm is 10%. And just try to take a long-term view as best you can. So that would be, I think if you do that, stick with that plan, it's going to turn out well at the end.
Last thing I'll add is just another variant to what Mike says is the fact that just like anything in life, whether it's diet, nutrition, fitness, having that discipline plan that you stick to when times are difficult. Times are difficult right now, and this is where the most people are deviating from their plan. If you can stay disciplined during times like this, the odds of success skyrocket.
Well, that's an excellent way to finish this today. Dave and Michael, thank you so much for your time.
Thank you, Sarah. It's pretty great.
Yeah, thanks for having us.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.